Hi, I'm James Dunn. Welcome to the Inside Network.
As global stock markets continue their bull run, joining me today on INDepth is Patrick McKeegan, Portfolio Manager at the Franklin Global Growth Fund, to discuss the role of diversified exposure to innovative, high-growth companies in the sectors such as technology, healthcare, and consumer goods that are largely driving global economic expansion. Welcome, Patrick.
Thank you.
Patrick, let's begin by discussing the philosophy of growth. Growth is often a shorthand description for a variety of approaches. What is the Franklin approach and philosophy to growth?
Yep. So we do global growth a little bit differently with our team. So to start, we have a long-term, bottom-up, concentrated, and benchmark agnostic approach to global growth investing. For our product in particular, we focus more on pure play businesses that often tend to be more in the mid and large cap space, where we can have concentrated, high conviction exposure to a select number of companies that we think have outstanding characteristics. Another differentiating aspect of our team is that we have a dedicated analyst team focused on our product. Our analysts are very empowered, they're aligned, they're only responsible for covering 10 companies in the portfolio. And so we believe that they have a better depth of understanding relative to the rest of the market. So we think that we're differentiated in that respect. For us, growth also means more of a focus on free cash flow growth. So it's less about maybe pie in the sky addressable markets or revenue multiples or things like that. We're much more grounded in free cash flow at the end of the day. And so I think what connects a big picture attractive growth opportunity in the global economy with free cash flow growth is really being students of value chains, which is what we focus on. And what we focus on is understanding a value chain around an economic growth opportunity and identifying where the choke points are in that value chain, where maybe there's more of a duopoly, where we can be more confident that the economic opportunity and the economics from a certain growth opportunity are going to accrue to the companies in the portfolio, and that will then ultimately reward us as shareholders. So that's our a little bit differentiated approach to growth investing.
The Global Growth Fund is also quite differentiated to the rest of the market in terms of having a slightly mid-cap bias, but more recently the Magnificent Seven of the mega caps have really dominated investor discussion and approach. Even more recently, the Magnificent One, as all investors talk about. You don't own any. What's behind that philosophy?
So historically, our group is focused more on those mid and large cap companies and not the mega cap companies. And if I just kind of marry that with that discussion earlier about our team and our process, what we've found is when you have these analysts with resources, with a tremendous degree of focus and ability to sort of spend time, take a long-term approach on a concentrated number of ideas, they're most able to find the most differentiated insights when they're focused more on that mid and large cap space. And we think ultimately that's really what warrants active management, is finding some of those things that are less discovered in the market and then being able to be rewarded for them. So that's how we've focused historically. That, it's interesting, historically that's been aligned with where the market performance has been coming from. So going back to 2000, if you look at rolling 5-year periods, the MSCI mid-cap index has outperformed the large cap index in over 60% of those periods. So historically mid-caps have outperformed. To your point, that's not the environment that we're in now. Currently, market performance has really been driven by mega caps, and that's been a headwind for our strategy. So we have owned mega caps in the past. There's nothing to say we can't do that. This portfolio has had positions in Apple in the past. It's had positions in Amazon. But what we prefer to do is to think about those economic growth opportunities and think if there are other less discovered ways that we can have exposure to those in the portfolio and have more differentiated ability to add value for our clients. So for us, if you think about something like an Amazon or a Microsoft, instead of those positions, we would have positions in Mercado Libre and Shopify to take advantage of opportunities such as e-commerce or software enabling greater productivity in the workforce. Instead of something like NVIDIA in the semiconductor space, we have positions in advanced micro devices, Onto Innovation, and MongoDB to take advantage of opportunities around Gen AI, and that broader semiconductor complex. And instead of Google or Facebook in more of that digital advertising space, we have actually a position that I can't tell you about yet, but that I can reveal next time. So also an attractive space for us as well.
As you say, investment trends wax and wane, and that the trend of the mega caps driving the market is waxing at the moment. So in periods like the current one, when your philosophy is not the one that's in the driver's seat with respect of market performance, how do you temper the frustration of clients and even the investment team in those scenarios where your philosophy is not the one that is waxing?
So I think to take a step back, we have a long-term track record with this strategy, which is beneficial in times like this. It helps us stick to our guns. So this strategy in its current form in this group dates back to 2002. So we've seen some of these cycles that have gone against us. We're benchmark agnostic, and so we have 95% plus active share. There are periods when we've outperformed meaningfully. There are periods when we've underperformed noticeably. Over the long term, that's balanced out more in our favor, and we've had outperformance, but certainly more of a difficult period now. So our clients are generally aligned with us in taking that long-term view of investing. They'll stick through some of these style headwinds that we're experiencing currently. And so we have that active dialogue and active conversation, but generally we have that long-term alignment. I think what our clients would be certainly very reluctant to see, and what we don't intend to do, would be to try to move away from being bottom-up stock pickers and more towards making market style decisions just because things aren't going our way. So we're going to stick to our knitting. We're going to continue to focus more on that mid and large cap space where we can be more differentiated with our idea generation. I think then when we will be rewarded when the market shifts back more in our favor. There are maybe some signs that that's starting to happen, but we will be rewarded for that. I think the other thing that I would tell clients is it's a frustrating period. We appreciate their support for the longer term. We're sticking to our knitting here. We feel that their pain as well from how we're compensated perspective, how our team is compensated. That's based on the performance of the portfolio, and so we feel that. But at the same time, we have conversations within the analyst team about how can we optimize our process? Is there anything that we could be doing differently? The conclusion of that is that the team remains very committed to this strategy, and we're going to see this cycle through.
Often people say it's different this time, and there does appear to be an element of that with the concentration bias that's driving the S&P 500 and the way the mega caps have performed. But longer term, those situations always normalise. And so is that the message that when that does happen, you will have this concentrated portfolio of high quality mid caps that will then be really well poised to outperform over the medium term?
Yep, that's the message. And I think that when you think about the factors that have driven the mega cap outperformance recently, there are two that are maybe really front of mind for me. So the first one is Gen AI. Really 4 or 5 out of the 7 mega caps have been benefiting from that Gen AI narrative. And the second is the rate environment. And in particular, what that rising rate cycle did was drive, in my opinion, a risk aversion, which led to maybe some greater concentration in the mega caps, which were a little bit more safe haven. So when you think about Gen AI, one of the things that I think is noticeable is really within the Magnificent Seven, you have 4 of the companies that are hyperscalers that are competing in a very CapEx intensive way, and there's 4 of them all competing. When you look at our portfolio, the exposure to Gen AI that we prefer to have is more thinking about what's going to be the next step in Gen AI development. So it's not that we're disbelievers in Gen AI by not owning the Magnificent Seven. It's just that I think that our portfolio has more creative exposure and more forward-looking exposure to Gen AI. And so when I say that, what I mean is if you think about a company like AMD, which is increasingly taking on NVIDIA in the GPU space, I think that their competitive positioning will be more differentiated as we move from training to inferencing in terms of large language model development. For Onto Innovation, another company in the portfolio, they stand to benefit as the chips that are being used in the GPUs become more architecturally complex. So they'll see an outsized benefit from that. Similarly, MongoDB, a database company in the portfolio, will benefit as some of this Gen AI technology is commercialized in software and database intensity increases. So I think that we're very well positioned on more of a forward-looking perspective in that Gen AI conversation. The second piece in terms of that mega cap, what helped the mega caps more recently and that rate cycle, that's turning. That's going the other way now. And so you've had central banks around the world really are taking down the short end of interest rates. And that's benefited, that's helped with the market broadening that you've seen in the third quarter here. So it's early days, but that's led to greater risk appetite in the market. And I think that as that condition, as that trend continues and as economic conditions continue to remain fairly favorable, the global economy is fairly robust, that would bode very well for our strategy.
What are the stocks in this environment that you're quite excited about? You've mentioned a couple of names already. Are those the kinds of stocks that you feel you'd like to get positioned in for when the mid-cap strategy starts to reassert itself?
So one idea that I think is interesting is Partners Group, which is a Swiss private markets company. They are differentiated in their competitive positioning because they have more of a portfolio approach. They're delivering private market solutions that cater more towards smaller institutional clients, as well as evergreen funds that are well suited for wealth management. And those are both areas that can see a greater sort of secular uptake of private market solutions over time relative to some of the larger institutional customers. Recently, they've actually been penalized because of that rate cycle conversation. So there are wider bid-ask spreads in private markets that relate to private equity companies essentially having more difficulty accessing attractive financing. As rates come down, we expect that to be an unlock for M&A activity in private markets that should reduce some of that cyclical headwind for partners and be more of a catalyst so that people can see that secular growth opportunity. Another one, a more recent addition to the portfolio is TE Connectivity. So that's a company that's making electrical wiring connectors that go into, their biggest end market historically has been in automotive. That's about 50% of their business. So they benefit from greater vehicle electrification. That's not just EVs. If you think about the active safety features on your cars and how that's developed over time, that will be using more of TE Connectivity's products, and they have very strong market share there. In addition to that business, they also increasingly are growing in the data center space. And so they have these wire connectors that are helping NVIDIA connect their racks and these solutions that they're selling around Blackwell and the like. And we think that that's an underappreciated source of optionality as they continue to grow. And then just the last one that I'll throw out there, it's been doing well more recently, but I think DSV is really interesting, which is a Danish freight forwarding company. They actually recently announced that they're doing a very large acquisition of DB Schenker, which will make them the largest freight forward company in the world. And the stock's done fairly well recently, but I continue to think that the economies of scale and the synergies that they can achieve there are underappreciated. So there are a few things that are maybe a little bit more off the beaten path, and I'm excited about.
You mentioned before that the team really focuses on free cash flow generation, supply and value chains, and corporate governance. They're the things that seem to really drive the way you look at companies and assess whether you want to go into them. But then, what are the kinds of catalysts you're looking for that can kick those kinds of stocks up more towards your intrinsic valuation of them?
Yep. There's no one size fits all. And so I think that you have to, do the work, get the right insight, have the right view that's driven by our analysts in the case of our process, and then also just be willing to be patient. And a couple of the tools that we use for that are, we do think a lot about optionality, like we were just talking about with TE Connectivity. We build financial models, but then we stress test them, and we also think a little bit more creatively about what could really drive upside in this type of environment. And so a few kind of unlock examples that you've seen recently. One is Planet Fitness. The stock was really being punished at the beginning of the year because there were concerns that they wouldn't be able to shift their model to adapt for inflation, which was being very punishing for their franchisees. To top it all off, the CEO left kind of abruptly in the middle of that, throwing further uncertainty in the situation.
And Ozempic and those drugs, if they help people get in shape without having to do the hard work at a gym, that could also potentially have been a threat to them.
So that's interesting. The stock was selling off in kind of the early days of that, but you actually have muscle loss with Ozempic and the GLP-1s, and so doctors will suggest that you, for your health's sake, go to the gym as a part of those regimens as well. So it went from being a headwind to being a tailwind to now nobody's really talking about it in the context of the gyms. But so I think that's an example of some of the work that we were doing there, just thinking about optionality with the scenario analysis. How punitive could Ozempic be? How could they change their pricing model? How could they change some of their investment schemes to be more accommodated to franchisees? we had conviction around their ability to change their model. So we were adding to the position. They brought in a new CEO who had a similar vision to us, and we were rewarded for that. Another company, I think, just in terms of taking that longer term perspective, we've had Mercado Libre, which is an e-commerce company in Latin America, in the portfolio for over a decade. When we started, that was really just an e-commerce marketplace. They then innovated. They sort of created additional growth opportunities. They moved into Mercado Pago, which is a PayPal-like offering in Latin America. And then from there, they built out a logistics network similar to what Amazon's done in the US. And then more recently, they had a credit initiative for small businesses called Credito. With each step of that journey, the market's been skeptical of those new initiatives, but by doing our own work and having confidence in kind of that innovative culture and getting to know those management teams, we've been able to maintain conviction through a lot of those dips over that 10-year history and have really been rewarded for that. So that's sort of how our strategy comes to fruition there.
How do you manage risk in terms of running the portfolio? And obviously risk has a short-term and a medium-term and a long-term component. So what are the bones of the risk management philosophy?
We take an economic exposure approach to managing risk in the portfolio. And so what we're trying to do is identify common economic exposures between the holdings and limit the overlap there. So when I say economic exposure, what I'm talking about is what's ultimately driving the free cash flow or the earnings for the company in the portfolio. So we would be thinking about what types of businesses have common customer sets, have common suppliers, have common geographies that they're operating in, or have common growth themes or growth drivers. And then we would limit the overlap between those companies. And so in doing that, that gives us a fairly concentrated portfolio with about 35 positions, but one that's still diversified and is touching a number of growth drivers throughout the global economy. And I think the other piece, there's a lot of discussion now in terms of some of these risk management frameworks with looking at factors, things like that. We do pay attention to that. But I would note that a lot of that's more quantitative and backward looking, where I think our approach is differentiated in being more fundamental and forward looking.
What are some of the major thematics that you like at the moment and that are playing into your portfolio construction?
Yep, we've talked a lot about technology so far, so I'll give you a few other examples. One is manufacturing automation. So we have exposure there with Manhattan, with Rockwell, and to some extent Zebra, although that's a little bit more of a supply chain technology story. So as supply chains were realigned during the pandemic, coming out, people want their supply chains to be more flexible. They don't want to be as dependent on China. They want to be able to more quickly shift regions that they're sourcing from. And as there's been some degree of nearshoring, there's also been a push for greater automation. So that's been an attractive area that we've been investing in. We've had a position for a few years now in intuitive surgical with robotic surgery. So I think another area of technology that's interesting. Outside of GLP-1s in healthcare, I think that there's still a lot of innovation in oncology, particularly with innovations like antibody drug conjugates. So that's an area where we have exposure.
This has been In Depth with Patrick McKeegan, Portfolio Manager at the Franklin Global Growth Fund. Patrick, super interesting. I would have loved to have kept going with this conversation. Thank you very much for coming in.
Thank you, I appreciate it.